how quickly the world can change. Inflation is back, and how? After so many years of struggling to lift it up to target, central banks are again facing the once painfully familiar challenge of bringing it down. Despite the urgency of the task, or perhaps because of it, now it's a good time to step back and scrutinize the old enemy once again, but with fresher eyes. As Agustin noted, this is what we do in this year's annual economic report in Chapter 2. We look at inflation under the hood, as it were, or, if you prefer British English, under the bonnet. We do so to examine more closely how its engine works and to inform policy. Looking under the hood provides a complementary perspective to the more traditional analysis captured, say, by a stylized Phillips curve. It means examining in detail how individual sector-specific price changes interact with the aggregate price index, that is, with inflation proper, and how wage and price setting is influenced not only by cyclical factors, economics lag, but also by structural ones, and importantly, let me stress, importantly, the behavior of inflation itself. The result is a characterization of the inflation process as two regimes, a low inflation and high inflation regime, and transitions across them. This complementary perspective yields at least three insights that shed light on the current challenge. First, low and high inflation regimes are very different. In a low inflation regime, in contrast to a high inflation one, inflation has important self-equilibrating properties. Second, transitions from low to high inflation regimes tend to be self-reinforcing. As inflation increases, so does the risk that it becomes entrenched. And finally, it is desirable for monetary policy to adapt to these regimes, as well as to the transitions across them. Monetary policy can afford to be more flexible in a low inflation regime, which it brings about and hardwires, and needs to be especially timely and decisive during transitions. Now, let me elaborate on these points. When examining the behavior of inflation or the inflation engine at low and high revs, as it were, it is useful to consider in turn the relationship between sector-specific price changes and inflation, and that between wages and prices. Looking closely at the behavior of sector-specific prices, well over 100 of them, reveals some otherwise hidden stylized facts. First, when inflation has settled at a low level, its evolution largely reflects idiosyncratic changes in sector-specific prices, or if you like, relative prices, rather than their co-movement. The first panel in this graph on the left illustrates the point. The panel is based on data for the US, for which the longest and most consistent statistics are available. We see that as inflation declines, so does the common component of price changes, which is a measure of their co-movement. We see that the red line falls alongside the yellow one. Second, and closely related, the well-documented decline in the volatility of inflation associated with lower inflation does not reflect the decline in the volatility of individual price changes, but rather in their co-movement. The same graph illustrates this point based on data also for Japan and Mexico, more representative of a broader range of countries. We see that the blue shaded areas shrink much more than the red shaded ones. Third, and confirming the previous picture, in a low inflation regime, the transmission across prices becomes more muted. We can see this in several ways. For one, spillovers across sectors become less intense and pervasive. In the left-hand panel of this graph, which shows an index of such spillovers, the green bar is lower than the red bar. Similarly, the pass-through of outside price increases to core inflation becomes hardly visible. The same pattern is evident in the right-hand panel. Finally, increases in the prices of salient items feed less into overall inflation. In the left-hand panel of this graph, we see that the impact of an oil price shock is smaller in a low inflation regime. The green bar is much lower than the red one. In fact, the impact is even estimated to be negative, but it is hard to distinguish it from zero in statistical terms. Likewise, the impact of an exchange rate shock falls with the level of inflation. Compare the size of the bars in the right-hand panel. These various findings are consistent with the well-documented, stylized fact that the persistence of inflation is lower in a low inflation regime. That is, that shocks to the inflation rate are more short-lived, as illustrated in this graph. In the graph, the persistence of price changes in a low inflation regime is plotted on the horizontal axis, and that in high inflation ones on the vertical axis. The left-hand panel portrays the behavior of the aggregate price index. We see that most of the red dots, one per country in a representative sample, are above the 45-degree line. Looking under the hood sheds further light on this relationship. It indicates that this property holds also for sector-specific price changes. The blue dots corresponding to multiple sectors per country are also above the 45-degree line, and that we can see in the right-hand panel. Now, the broad picture that emerges is, I think, very clear. A low inflation regime, in contrast to a high inflation one, has important self-equilibrating or self-stabilizing properties. Sector-specific price changes move together hardly at all, and they leave only a temporary imprint on the inflation rate. Now, the core of the inflation engine is the self-sustaining interaction between wages and prices. Ultimately, for inflation to become entrenched, wages must chase prices and prices must chase wages, so-called wage-price spirals. Thus, the stylized facts just described must be consistent with those concerning wage and price formation, which both reflects and determines those facts. This is indeed the case, as illustrated in this graph, based on single regression exercises. The response of wages to prices is milder in a low inflation regime. In the left-hand panel, the green bar is lower than the red one. And that of prices to wages is also milder. In the right-hand panel, we see the same pattern. Now, the implication is that in a low inflation regime, wages and prices are more loosely linked. This can be shown more formally by examining their joint behavior and the speed of adjustment to each other, as is done in this graph. We see that it takes considerably longer for wages and prices to catch up with each other. The green bars are higher than the red ones. Now, so much for the stylized facts concerning the two regimes. What about the all-important transitions across them? Understanding the transitions requires delving deeper into the determinants of wage and price setting. We know that ultimately, the extent to which wages and prices chase each other depends on the incentives and on the pricing power of labor and firms. Three types of factor stand out. The first type, which influences pricing power, comprises structural forces. The obvious candidates here are globalization, demographics, technology, as well as political preferences concerning the role of market forces in the economy. Now, in a Phillips curve, these factors are hidden in a possibly time-varying constant or time-varying slope. Now, these forces can be very important, as illustrated in this graph. Indicators of labor's pricing power, such as measures of the degree of centralization or the stringency of wage bargaining, point to a steady decline since the 1980s. That's on the left-hand panel. And the decline helps to explain the fall in inflation, as confirmed by more formal econometric analysis, which is not shown here, but is shown in the chapter. That said, structural factors move slowly, so they do matter for transitions, but only operating in the background. The second type of factor, which also influences pricing power, comprises cyclical forces. That is, the state of aggregate demand relative to the economy's productive potential, so-called economic slack. Economic slack is what the Phillips curve focuses on and is what monetary policy influences to shift inflation. It naturally plays a more prominent role during transitions. The third factor is the evolution of inflation itself. This affects both incentives and indirectly pricing power, and importantly, is what tends to make transitions self-reinforcing. Now, how? Well, for one, as inflation drifts away from very low levels, it moves from the region of rational inattention into that of sharp focus. In addition, as the under-the-hood perspective highlights, inflation becomes more representative. As the common component of price changes increases, the inflation rates that different ages experience become more similar. This is illustrated in the left-hand panel of this graph. The graph plots an indicator of the similarity of price changes on the vertical axis against inflation on the horizontal axis. We see that as inflation rises, so does the similarity of those price changes in both advanced economies, that's the red dots, as well as in emerging market economies, that's the blue dots. Now, in other words, as inflation increases, it becomes a more relevant focal point and coordinating device, as it were, for the decisions of economic agents. This strengthens their incentive to seek compensation for losses in purchasing power or squeezes in profit margins that they have already incurred. This, in and of itself, can trigger wage price spirals, regardless of what happens to inflation expectations. And since inflation expectations of workers and firms are backward-looking, higher inflation means higher expected inflation, which induces agents to seek compensation also for future losses and for future squeezes. Moreover, once that happens, contract length, the length of contracts fixed in nominal terms, becomes shorter and price adjustments more frequent, adding fuel to the fire. But the influence of inflation does not stop there. As inflation increases, it also encourages efforts to strengthen pricing power, such as calls for greater centralization of wage formation or for indexation or strikes. Indeed, as the right-hand panel of this graph shows, there is a close link between the level of inflation and the incidence of indexation clauses around the world. The bottom line is that higher inflation can trigger a self-reinforcing shift in inflation psychology. To put it in terms of the Phillips curve, during transitions, its parameters are far from constant. But what about the role of monetary policy? Well, we know monetary policy has always played a key role in the inflation process, both in high inflation regimes, such as during the Great Inflation era, and in low inflation ones, such as during the inflation targeting era that followed the great disinflation of the 1980s and 1990s. Monetary policy exerts its influence on inflation in two ways. First, through the characteristics of the framework. Think of the setup of a car. Relevant characteristics here include objectives, strategies, tools, and institutional underpinnings, not least the degree of independence from government. The framework is what has the biggest influence on inflation expectations, as well as on the features of wage and price formation. Second, through changes in the policy stance within the framework. Think of the accelerator and brake. Hence adjustments in interest rates and balance sheets, as well as signaling. The stance is what has the biggest influence on aggregate demand, as we know. The under-the-hood perspective sheds further light on the role of monetary policy within inflation regimes, as well as during transitions across regimes. In a well-established low inflation regime, monetary policy can afford to be more flexible. That is, to tolerate more persistent, if moderate, deviations of inflation from narrowly defined targets. Having gained precious credibility, the central bank can reap the benefits. Now, one reason is that in such a regime, inflation exhibits important self-equilibrating properties, as I discussed earlier. Another reason is that monetary policy seems to lose traction, and as a result, must adjust its instruments more vigorously. This in turn can heighten any negative side effects, such as those linked to interest rates that stay unusually low for unusually long. As this graph, based on US data, indicates, in a low inflation regime, monetary policy operates through a remarkably narrow set of prices, mostly in the more cyclically sensitive service subsectors. We see that a change in the stance, or what economists call a monetary policy shock, has a statistically discernible impact on a mere 30% of the consumption basket, even after 3 years. The loss of traction arguably reflects, at least in part, the dynamics of prices in a low inflation regime. Intuitively, monetary policy should have a larger impact on the common component of price changes, which is more closely related to aggregate demand, than on the idiosyncratic one. And as we saw, the common component falls substantially in a low inflation regime. Indeed, as we see in this graph, an easing of the stance has a clear impact on the common component of sectoral price changes, that's on the left-hand panel, and a hardly detectable one, statistically speaking, on the idiosyncratic component, that's on the right-hand panel. But it is one thing to tolerate moderate deviations from point targets, and quite another to test the system's self-equilibrating properties. The self-reinforcing nature of transitions from low to high inflation regimes puts a premium on a timely and decisive response to safeguard price stability. Once a high inflation regime becomes entrenched, transitioning back can be very costly, because the regime induces changes in the behavior of agents and because the central bank's credibility can be undermined. The risks are especially high in economies with a long inflation history or weak macroeconomic or institutional fundamentals. There, transitions can be especially fast, not least owing to sharp financial market-induced depreciations of the currency. A challenge central banks face is that, as further discussed in the report, transitions are inherently uncertain. There is no fully reliable real-time indicator. And it is precisely during transitions, that standard models have the hardest time. Because of the self-reinforcing dynamics and because of the data on which they have to be estimated, the models are least valuable when they're needed most. The most reliable indicator is clear signs of wage price spirals, so-called second-round effects. But by the time they appear, the cost of taking remedial action may have already grown substantially. Judgment is at a premium. To conclude, looking under the hood at the inflation engine provides fresh insights. It encourages us to think of the inflation process as represented by two very different regimes with self-reinforcing transitions from low to high inflation ones. And it provides clues concerning how to adjust monetary policy to the features of those regimes, as well as to the all-important transitions across them, underscoring the value of a timely and decisive response. This perspective is especially relevant today, as we know, as central banks again face the once but no longer familiar challenge of preventing one of those transitions. Thank you.